Have you ever looked at a company and just wondered, is it really as healthy as it looks on the surface? Well, today we're going to pull back the curtain. We're going to give you the diagnostic tools to perform a complete financial checkup on any company you want. Think of it like being a doctor, and we're about to read the patient's chart together.
So imagine you see a headline like this. A company's sales are up almost 29%. I mean, that sounds incredible, right? Your first thought is probably, wow, they must be doing great. But is that the whole story? It's kind of like looking at a person who seems perfectly fine on the outside, but you have no idea what's going on under the surface.
And that's exactly what we're going to do. We're going to treat this whole thing like a doctor's checkup. The different financial ratios and statements we'll look at, those are our diagnostic test. And each one gives us a really important clue about the company's actual health.
Okay, but before we can run any tests, we have to make sure we're reading the patient's chart the right way. I mean, you can't compare a multi-billion-dollar giant to a small local business, right? It's apples and oranges. That's where we need to standardize the numbers, and we do that with something called a common size statement.
A common size statement is basically our secret weapon. All it does is take every single number on, say, an income statement and show it as a percentage of total sales. Or, for a balance sheet, everything becomes a percentage of total assets. It's a really simple trick, but it's so powerful because it lets us finally compare companies of totally different sizes or just see how one company has changed over time.
And check this out. This is where you can really see the magic. On the left, you've got the raw dollar amounts. A net income of $42,000. I mean, is that good? Is that bad? It's hard to say without context. But now, look at the right. By turning everything into a percentage, the real story just jumps out at you. That net income is only 2.3% of sales. All of a sudden, you get it. For every dollar this company brings in, only a little over 2 cents is left as actual profit. Now that is a much clearer picture.
All right, so our chart is standardized. Now it's time for the first part of our checkup. We're checking the vitals. We're looking at the company's liquidity, which is really all about its ability to handle day-to-day financial stress and, pay its bills on time.
So, what is liquidity? The simplest way to think about it is this. Does the company have enough cash, or things it can turn into cash quickly, to cover its short-term debts? It's literally the financial pulse of the company. A strong, steady pulse means it's healthy enough to handle the little bumps in the road without a problem.
This is the big question we're trying to answer with this test. If a big, unexpected bill comes due, can the company actually pay it? To figure that out, we use a really important ratio.
And here's our test result. The current ratio is 1.95. So where does that number come from? Well, you just take all the company's current assets, so stuff it can turn into cash within a year, and you divide it by its current liabilities, all the bills it has to pay within that same year. And that 1.95, that's the key. It tells us that for every single dollar in bills the company has to pay off soon, it has almost $2 in resources ready to cover it. Generally, anything over 1 is considered pretty safe. So 1.95, yep, that tells us its financial pulse is nice and healthy.
Okay, so we know the short-term vitals are looking good. That's great. But now it's time for the full-body scan. We're moving on to solvency. This is all about the company's long-term stability and its fundamental ability to survive for years and years. We're looking at the strength of its financial skeleton, basically. To get a handle on long-term health, just think of a company's finances like this scale right here. On one side, you've got all its stuff, its resources, or what we call assets. On the other side, you have how it paid for all that stuff, its capital structure. That's either money it borrowed, which is debt, or money from its owners, which is equity. Solvency is all about keeping that scale balanced over the long haul. A key test here is the debt-to-assets ratio, which tells us exactly how much of the company is funded by borrowing.
And a huge part of keeping that balance is deciding how much debt to take on. Debt can be a fantastic tool. The interest you pay is tax deductible, and you don't have to give up any ownership control. But, and this is a big but, it comes with serious risks. You are legally on the hook for those payments, which adds a ton of risk and can make it harder to borrow more money down the road. This is why keeping an eye on that debt-to-assets number is just so critical.
So this brings us to the company's, let's call it a lifestyle choice. How much leverage is it using? Is it a high-risk adrenaline junkie that uses a lot of debt to juice its returns, or is it playing it more conservatively? This tells us a ton about its overall risk profile.
So leverage is basically using fixed costs, like the interest payments on your debt, to amplify your results. When business is booming, leverage can make your profits look amazing. But when sales take a nosedive, those exact same fixed costs can absolutely crush your bottom line. It is the classic double-edged sword. It makes the good times better and the bad times way, way worse.
Okay, we've run our tests, we've checked the short-term vitals with our liquidity ratios, we've done the long-term full-body scan looking at solvency and leverage. Now it's time to pull all these results together and make our final diagnosis.
And honestly, if there is one thing you remember from all of this, let it be this. No single number ever tells the whole story. Remember that flashy 28.6% sales growth we started with? That was just one symptom. A good diagnosis means you have to look at all the test results together. I mean, a healthy short-term pulse is great, but it doesn't mean a whole lot if the company's long-term structure is drowning in debt. You always need the full picture.
So let's quickly recap the new diagnostic toolkit you have. You now know how to standardize any financial chart using common-size statements. You can check the short-term vitals using liquidity measures like the current ratio. You can assess its long-term stability by looking at solvency. And you can get a sense of its lifestyle choices by analyzing its leverage.
So there you have it. You have the framework now to look right past the headlines and really understand what's going on inside a business. You can read the chart, you can interpret the tests, and you can form your own diagnosis. So the only real question left is, where are you going to start? Which company's health will you check first?